Good morning, everyone. The much awaited Trump's tariff announcement has come yesterday night, India time. And while on the face of it, it definitely is much harsher than what we were anticipating. It has come at 27% in the annexure versus what Trump has mentioned as 26%. I believe that tariffs generally have three-pronged impact. One, they are a kind of fiscal tightening on the whole world. Second, it definitely brings in lower growth, inflation. So I believe that the tariffs will be primarily a liquidity challenge, a growth challenge, and an inflation challenge for the for the world economy, and no one can survive that. Fortunately for India, the tariff seems to be lower than the competition, so we are relatively better off, but not absolutely better off. The tariffs, as I mentioned, are prima facie higher than what we have anticipated. This move has far-reaching impacts and implications for global trade and US economy. Just to quickly summarize on the tariff details, White House has imposed reciprocal tariff, 10% being baseline, which was already there, and India is at 27%, China 34% additional to 20% existing. So now China is at 54, Vietnam 46, Bangladesh 37, Indonesia 32, European Union 20, United Kingdom 10, and so on. While the tariffs are here, sectoral tariffs are still not there. So the sectors which have been exempted today, like IT or pharma, it doesn't mean that nothing will come in them. There could be some cost impact, some tariff which can come there as well. We expect more clarity as other countries either enter into trade agreements with the US or retaliate with measures of their own. However, retaliating with tariffs, I think, is a not so fruitful step, because number one, US tariff, the countries are already imposing much higher tariffs than what US has imposed. Secondly, US has not imposed to the extent they want to impose or they can impose. So any retaliatory tariff will mean that further imposition of tariff by the US, which I think is a counterproductive measure, and I believe that world and the other countries will adopt other measures like negotiation, currency devaluation, all those measures as the next step rather than retaliatory tariffs. The key question of this tariff, I think the genesis of the problem is that President Trump wants manufacturing to come back to US. The challenge in that is that the manufacturing cost in US cannot compete with the cost of other countries like Vietnam, China, Indonesia and all. And this problem has to be looked at more holistically and will take a decade or more for the solution, for a permanent solution, if you really want to produce in America. Secondly, the wage rates which are there in America, I don't think that you can do a positive value add to the economy by producing alone in America. So I think the genesis of the problem is much deeper. This could be a negotiation skill, this could be some tax gain scheme, but it cannot be a permanent solution in my view. The US has limited manufacturing capacity, and in some industries, even with tariff, domestic manufacturing costs are often higher than what importing nations can offer. Even with reciprocal tariffs in place, US companies may still be forced to import goods from these countries or face higher prices due to lack of domestic production. This also raises questions about long-term sustainability of tariffs. As an economic policy, higher costs could lead to much more inflationary pressure in the US, thereby restricting Fed from taking any rate cuts. What would be like? We are more worried on the economic outlook globally and on US particularly. The higher tariff, as I mentioned, are inflationary in nature in short term, leading to higher interest rates and potential slowdown in US consumer demand. A recession risk is also on the horizon, and we are consistently seeing the chances of the probability which leading brokerage houses in the US which are assigning for a recession in US are consistently rising. And this may actually push the US administration to reconsider this whole initiative which they have taken. Cascading effect of that, because US is a very big economy, the global economies, the other economies, especially the emerging markets, could also face problems. From India perspective, pharma, automobile, IT services, textiles, there has been some exemptions, particularly in IT and pharma. In auto and components, there has already been 25% tariffs. And in textile, the 27% tariffs are significant, but the good part is that the nations with which India competes, China, Bangladesh and Vietnam, they are at much higher tariffs. So I think it is a relative advantage for us. Same goes into the rice side. while there is a tariff for us, the tariff from other importing nations for US for rice is much higher. So the next thing which we believe will be bigger risk is the devaluation risk. China, Vietnam and Thailand, I don't think will go for retaliatory tariff. They will further devalue their currency, which will be taking off all the benefit of what imposition of tariff brings in for the US. So it is counterproductive in that sense. In my view, a weaker currency in these countries could make their exports even more competitive relative to India, thereby limiting any significant advantage which India might have today. Finally, what is impact on India and our research approach? India is impacted by the tariff changes, but on relative basis, because others are impacted more, we are better off as of today. Our net balance with net surplus with US is also low, and we also do substantial amount of pharma exports and IT services which are right now not touched. We believe that market from last 2 years of phenomenal bull run is now a market of stock pickers, which has to be bottom up. So we have to be very careful what we are buying. We have to remember that the bigger risk is not tariff, the bigger risk is global recession and global economic growth, and India can't be immune to that. But relatively our growth will still be higher than others. So that is a saving grace and silver lining. We need to monitor global retaliation, we need to monitor US Fed response, and finally we need to monitor how RBI acts on both currency and the rates. In the meanwhile, we continue our efforts on bottom-up stock picking, focusing more on where the earnings will come, where the impact of export is less, and that is our approach, and we'll continue in that approach. We wish you a good day, and thank you.